By retirement age, superannuation is often the largest assets people own. But how does Centrelink assess superannuation? How is your age pension affected? In this video, I'll break down how different types of super like accumulation accounts, transition to retirement pensions, and account-based pensions are assessed by Centrelink. Then I'll walk you through a practical example to show how it all works in real life, along with strategies to boost your age pension and important considerations to keep in mind. Before we dive in, I want to take a moment to emphasize just how important this topic is. There are 3 key reasons why every pre-retiree and retiree needs to understand it. First, superannuation affects eligibility for a wide range of Centrelink benefits, not just the age pension. Even if you're not eligible for the age pension, it can still be relevant for assessing other benefits. Second, even if you don't qualify for the age pension now because of the assets test or income test, this might change as you reach your 70s, 80s, or 90s. At that stage, the age pension could become a crucial part of meeting your income needs. And finally, if you're under age pension age and don't qualify yourself, your super could still impact your spouse's Centrelink assessment if they are over age pension age. So with that in mind, let's start with the basics. First off, I will be making a separate video about defined benefit super. Today's video, however, is all about non-defined benefit super. There are 2 phases to your super, the accumulation phase and the pension phase, also called the drawdown phase. In the accumulation phase, your super is held in a super accumulation account. In the pension phase, you might have a transition to retirement pension or account-based pension. In Australia, the age pension age is now 67 for everyone. For a super accumulation account, if the account holder is under age pension age, Centrelink treats it as if it doesn't exist. This means it won't count towards either the assets test or the income test. So, a super accumulation account held by someone who is under 67 is a perfectly legitimate place to hide money from Centrelink to boost your Centrelink benefit. However, once the account holder turns 67, Centrelink will start assessing the accumulation account for both the assets test and the income test. For a TTR pension and account-based pension, regardless of the account holder's age, Centrelink will assess them under both the assets test and the income test. Under the assets test, the account balance of a super accumulation account held by someone 67 or older, as well as balances in a TTR pension or account-based pension, are included in the total assessable assets. These accounts are treated as financial assets. Under the income test, Centrelink applies deeming rules. This means it assumes a fixed rate of income based on the total value of your financial assets, regardless of how much pension you withdraw or how much your investment actually earn. Here are the current deeming rates. 0.25% is applied to the first 62,600 of financial assets for singles, or the first 103,800 of combined financial assets for couples. 2.25% is applied to any amount above those thresholds. Centrelink calculates your deemed income and adds it to any other income to determine the total for the income test. Now let's walk through an example together. Meet John and Jenny, a retired couple who own their home. John is 62 and Jenny is 67. Their house is valued at $1 million. They have home contents worth $10,000 and a car valued at $40,000. To focus specifically on superannuation, we will assume they have no other financial assets or sources of income beyond super. John has $200,000 in a super accumulation account and $300,000 in a transition to retirement pension. Jenny has $500,000 in an account-based pension. The first step is to identify the rates and thresholds used in the age pension calculation. This depends on your relationship status, whether you are single or a part of a couple, and whether you are a homeowner. In the Excel templates, I've included the latest rates for all scenarios. However, to calculate for a specific situation, you only need 4 key numbers. Since John and Jenny are couple homeowner, we need the full fortnightly pension rate for couples, the lower asset threshold for couple homeowners, the lower income threshold for couples, and the deeming rates that apply to couples. For easy reference, I have placed these figures next to our example. Let's start with the assets test. Their principal residence is not assessed. The home contents and car are assessed as non-financial assets under the assets test only. Since John is under 67, his 200,000 super accumulation account is excluded from both the assets test and the income test. However, John's TTR pension and Jenny's account-based pension are considered financial assets and are fully accessible. The total value of their non-financial assets includes their home contents and motor vehicle, which comes to $50,000. Their total financial assets include John's TTR pension and Jenny's account-based pension, which equals $800,000. Adding this together, their total accessible assets come to $850,000. Since this amount exceeds the lower threshold for a homeowner couple that don't qualify for the full age pension, the excess assets are $380,000. For every $1,000 of excess assets, the pension is reduced by $1.50 per fortnight for each member of the couple. This results in a total reduction of $570 per fortnight under the assets test. After applying this reduction, the age pension entitlement is $292.60 per fortnight. Since John is under 67, he is not yet eligible for the age pension, so this amount reflects Jenny's entitlement under the assets test. Now, income test. Centrelink applies the deeming rules to calculate income from financial assets. For John and Jenny, this means that out of their total $800,000 in financial assets, Centrelink assumes the first $103,800 earns income at a rate of 0.25%, while the remaining amount above $103,800 earns 2.25%. The total deemed income is then divided by 26 to calculate the fortnightly figure. Since I have no other income, this is their total accessible income. Because this amount is above the lower income threshold for a homeowner couple that don't qualify for the full age pension, the excess income is $240 per fortnight. Under the income test, for every $1 above the lower threshold, each member of the couple's pension is reduced by 25 cents per fortnight. Based on this, age pension entitlement under the income test would be $802.48 per fortnight. Since John is under 67, he is not yet eligible for the age pension, so this amount reflects Jenny's entitlement under the income test. Centrelink applies both the assets test and the income test, but the one that results in the lower pension amount is the one that determines the payment. In this case, the assets test gives Jenny a lower pension, so it becomes the deciding factor, meaning she is asset tested. As a result, Jenny will receive $292.60 per fortnight. How can John and Jenny improve Jenny's age pension? Let me show you how we can boost her age pension all the way to the full amount. Before we begin, a quick disclaimer: this video is for educational purposes only, not financial advice. The example here is simplified to explain specific rules. Your situation could be more complex, so make sure to do your own research or seek professional advice before taking any actions. As we discussed earlier, a super accumulation account held by someone under 67 is not counted by Centrelink. John can roll his $300,000 TTR pension back into his super accumulation account. This would reduce their accessible financial assets by $300,000, leaving their total accessible assets at $550,000. While this is still above the lower threshold for the full pension, the excess asset is much smaller, and Jenny is able to increase her age pension from $292.60 per fortnight to $742.60 per fortnight. Quick note: when you use this template, having assets or income below the lower threshold gives you the full age pension, and it won't increase it beyond the maximum amount. I've kept the formula straightforward to make the logic easy to follow, but if the excess assets or excess income ever drop below zero, please adjust them manually to zero. What else can be done? Can we boost Jenny's pension even further? Well, Jenny can withdraw $80,000 from account-based pension and give it to John to contribute to his super accumulation account. This effectively hid another $80,000 from Centrelink. By doing this, their total accessible assets drop further, right down to the lower asset threshold, allowing Jenny to qualify for the full age pension. This is a powerful strategy for couples where only one partner is above age pension age. Of course, when John turns 67 and his accumulation account becomes accessible, they will need to explore other strategies to maximize their age pension entitlement. Now, before taking any steps to implement these strategies, there are several important factors to consider. First, it's important to consider your income needs when transferring funds from one spouse super to another. Moving money into a super accumulation account means those funds could become inaccessible until the account holder meets a condition of release. Will locking those funds away impact your ability to meet your financial needs, including everyday expenses or any larger plans that require access to those funds? Your answer to that question will determine how much you can reasonably transfer without compromising your financial stability or flexibility, even if it increases your age pension. Next, tax implications. When money is in a super accumulation account or TTR pension account, any earnings on those funds are taxed at 15%. In contrast, earnings inside account-based pension are tax-free. This means rolling money back into accumulation account could result in higher taxes on your investment returns. You will need to weigh the potential tax impact against the benefits of improving age pension. Let me know if you want me to dive deeper into the numbers and calculations about this in a future video. Another factor is transaction costs. Moving money often involves selling investments, which can lead to buy and sell costs or brokerage fees. Depending on the size of your investment and the fees involved, this cost could add up. You will want to carefully evaluate whether the financial benefits outweigh these transactional expenses. Additionally, contribution caps and total super balance matter. The ability to contribute to a super accumulation account isn't unlimited. It depends on factors such as your contribution caps and total super balance. If you have already used up your available contribution caps or have a super balance above the threshold, you may not be able to contribute the desired amount. Understanding these limits is essential to avoid penalties. Finally, consider your comfort level with transferring money to a spouse. For these strategies to work, one spouse may need to transfer money to the other's super account. While this can be a practical solution, it may not feel comfortable for everyone. It's important to consider your personal circumstances, trust levels, and any potential relationship dynamics that might come into play when transferring funds. Each of these considerations will vary depending on personal situation, so it's a good idea to seek professional advice before making any decisions. If you want a copy of this Excel template to get a head start on your own calculation, head to the link in the description box down below. Having a younger spouse helps, but it's not the only way to boost your age pension. Check out this video to discover many more tips and strategies to maximize your entitlement. Thanks for watching. I'll see you in the next one.